Hey, thanks so much for stopping by Premier State Investing. We're going to be looking at Genworth today. I want to start with an Excel sheet that I put together for a friend of mine who well, let me say it like this. Many of us either know someone or maybe we're, a policy holder with Genworth for long-term care coverage. They recently lost, this is a misspelling, but it's Skochin. There was a decision basically about huge rate increases on the premiums, and a lot of people, it's just, it just caused a lot of problems. So what they've done is they lost this lawsuit. They've basically approached policyholders with a number of different options. So the person that I saw had like 4 different options in addition to their current plan. So what I try to do is just build something like a little model that helps kind of sort through all the confusions, because there are a lot of moving parts. So first of all, you can download this. I'll put a link for the website, premierstudyinginvesting.com, and you can see it there. You can download this sheet. I locked a lot of these cells except for the green ones. So if it's green, you can input something in there and it'll change, it'll update. But these other ones, no. So if you try to say like delete this one or something, it should give you an error message. Anyways, so if you look at the different, so I can't even click into these cells. Okay, so they're locked, so I can't click into them, just the green ones or some of the white ones. But what to say? So I give you these different input boxes. So from the top, probability of a huge premium increase over the next 3 to 5 years. So the document that my friend sent me, they said, oh, we're going to have these big increases somewhere between year 3 and year 6. And I read on the literature that some states, they really don't allow these large increases. One thing that I thought of was probably like Florida. It goes out of their way to protect the senior citizens that move there and live there and all that stuff. But yeah, if there's a low percentage, then it's not very likely. If you put it more like 85, 86%, you'll see an update here. So this is when the rate hike kicks in the 4th year in this model. You'll notice that I'll finish walking through these and then we'll go over to the right. So how much is the rate increase going to be? So anywhere between like 60 and 154% is what I saw. So you can pick a number between those two. Expected inflation rate, meaning how much on average do you expect the cost of long-term health care to go up, because that is going to be a big factor. Core CPI, I think core CPI or CPI in the United States was somewhere around 5% between 2020 and 2021. And so those numbers are a little bit squishy. I'm not sure exactly 5%, closer to 6, closer to 4.5. I'm not sure if that was rounded up. And those numbers are always estimates. They've taken a lot of factors to come up with that. Expected 10-year government bond interest rate. I don't think I didn't incorporate that into the system or to the model. And then growth rate of daily benefits in the current plan. So if you have a current plan or another plan that has like a growth rate, then you want to incorporate that, right? So 5% would increase your daily benefits from 289 to 303, 319. It would increase it 5% a year. Also, how much have you paid in to date? So cumulative paid in by customer, for example, negative 35 would be like $35,000 out, right? So definitely don't want to put a positive number. You paid something out, so put a negative number in here. Okay. You can put your age up here, and it goes out till 2040, so that's quite a ways away. Although maybe it should be even longer than that. But that's what I did for this. So let's look at this. Here, this is just the unadjusted premiums, meaning the premium that you're paying now. So this is current plan. This is, we're calling option 4. But you can see that the unadjusted premiums could be a little bit different. So this is what are you paying right now? And then premiums with increase from inflation. So in the first year, there's no impact on inflation. But you'll see unadjusted are going to repeat. They're going to be the same every year. And then these numbers are basically going to grow. So I'm putting the 4% or whatever you choose here for your inflation rate. It's going to punch this up from 3262 to 3393 to 3528. Okay, so that's where you're going to see your increases. So let's make sure this should change. Let's see if I can get this to go to 4,000 by increasing the inflation rate to 8%. 3805. Oh, these are changing as well. Yeah, 3523. Yeah, 3393. Yeah, so as I change that back and forth, yeah, okay, so it works. Okay, so the inflation kicks in here, and then this rate hike from this box won't kick in until year 4. And that's kind of how it works. So what you end up having is cumulative paid in by a policyholder by year, right? So it's this number, say the first one would be however much you paid in previously, plus whatever you pay in here. Boom, and that'll be the cumulative paid in by the policyholder. Then you have benefits per day. You can annualize those benefits per day. So if you have annualized benefits of 105, right? So, I mean, basically, if you can use it, I mean, you don't want to go into long-term care right away, right? But you could see it's a benefit to the person in this situation where the less number of payments that they have to make and the sooner they can start cashing in their benefits, the better the difference is. And the difference, a difference, positive is good difference, meaning, it's the 105, 485 minus this number here. As time goes on, right, actually it breaks down, looks like to the company's favor in the 14th year under this situation, okay? Now all these numbers will change based on how much is the rate increase and the probability of it occurring and all that stuff, okay? Because you don't know, you have to have that probability part in there because you don't really know. You have to make some kind of assumption. And because I give you this to you, you can put in different assumptions. You can go 50-50 and say like, well, how many years until, a break even here? Well, if it's only a 50% likelihood of occurring, then I can go out to year 18 and still, have a favorable thing. It also helps you in some of your, like how much would you have to pay in 2038? You'd be paying in somewhere like $21,000 a year in premiums, right? That's with an inflation rate of 8%. That's a very high inflation rate. I'll go back to 4. But still, it helps you for your budgeting as well. And then what else do I have to say? You can just, basically the things that are going to be different if you come on to another option is going to be your unadjusted premiums because that'll be different under each different option that they give you. And then your daily benefits. This is not labeled, but this is benefits per day. I need to label this here. Control copy. I think I overwrote that just a minute ago. So benefits per day, 100 or 257 or whatever it is. And then if there's no increase, like in this situation there's no increase, then it's just flat 257 forever into the future. So let's jump over to the video. I want to look at Genworth, just their financial situation as far as their solvency. They have $1 billion debt due September 2021, which is just around the corner at the making of this video. We're in August of 2021. And I just want to see what some different commentators are saying, looking at a lot of headlines, basically, to help give you a jump start or a running start if you want to really think, is this company going to be solvent? It doesn't do you a lot of good to pay your premiums faithfully every month and then this company go out of business in 2 or 3 years and leave you holding the bag. So I'm trying. Just very quickly want to look at the price chart for GNW. This is the main holding company, Genworth Financial, traded on the New York Stock Exchange. So today, $3.72. I want to scroll down and just let you get a look at some of these ratios. Risk analyst. I think this is the proper lettering for that. And from what I've heard, not an easy designation to gain. It's very quantitative in nature. Anyways, it was the deal would have gone through with Oceanwide if the price would have hit $5.43. It never got there. So let's look here, a financial predicament. We want to skip over some of this stuff, but Genworth has shifted its attention to resolving over $1 billion of 2021 debt maturities. So they have $1 billion cash and liquid assets at the end of 2020. So they're going to use about $340 million of those to repay some of that debt. So we're here 2019. And this is old, but you could see less and less people are jumping on the Genworth bandwagon. It appears blue here. This is the renewals. So it seems like there's not a lot of new money coming into this. Here's where he said he talked about the IPO. If they did the IPO of that one segment, they could bring in about 600 to 700 million. But since it's a necessary stopgap, prime assets, she says. So she thinks they're going to have to start selling off the profitable aspects of their business. She goes on, should Genworth spin off its profitable businesses, it would set up the remaining unprofitable long-term care business to, quote, in effect, go insolvent. And that's a quote from Bernie Birnbaum, who serves as the executive director for the Center of Economic Justice, a consumer advocacy group. So the deal with Oceanwide falling through certainly doesn't help anything, he says. At best, it does not make things worse, but it probably will. Okay, so there's our first look. Okay, so next we have a credit rating that came out from AM Best on Genworth Financial. So Genworth actually has a number of different tickers. We have the GLIC, we have the GLICNY. But the main one that we've been looking at, traded on the New York Stock Exchange, is the GNW. And that one got a B rating. Okay. So in this article, they give us a link to AM Best. You can see that here. Their long-term issuer credit rating, and the B that we saw is marginal. The definition: assigned to entities that have, in our opinion, a marginal ability to meet their ongoing senior financial obligations. Credit quality is vulnerable to adverse changes in industry and economic conditions. So, depends on your outlook. I mean, essentially, your views on inflation. This is what I told my friends. It depends what you think, how the economy is going to go, what you make of the Fed intervention, what you make of efforts to keep everybody healthy, the unemployment numbers, these types of things. Sorry. Next, we're going to jump over to Moody's Investor Service Rating Action. Moody's assigns provisional rating to mortgage insurance credit risk transfer note issued by Triangle RE. Essentially, Triangle RE is the second transaction under the Triangle RE program, which transfers the capital markets and credit risk of private mortgage issuance policies issued by Genworth Mortgage Insurance, Genworth the seeding issuer, on a portfolio of residential mortgage loans. So Genworth is apparently also involved in mortgages. And the complete rating actions are as follows. So this is a little bit more technical article than I want to jump into. They talk about some of the, they did different stress tests. One said, under this scenario and that scenario. But here's the list. So BAA3, BA2, BA2, B1, B2, and I'll put up a list of the Moody's scales. These are not strong ratings, though. Next, from December 2nd, 2020, Genworth 17 Annual Cost of Care Survey. Looks like exacerbates already rising long-term care costs. Care providers foresee additional rate hikes in 2021. They have an explore cost of care data by city or zip code. That's pretty interesting, actually. But assisted living care facilities rates increased 6.15%. Cost about $51,000 to stay in assisted living facility. And then home care services, so they do like the cooking, the cleaning, right? Up 4.4%, so still kind of a lot, $53,000 a year. And then if you have a semi-private room in skilled nursing, this is where it's really expensive, $93,000 a year. And private room in a nursing home, $105,000 a year. It says rates are on a rise. Why? They mention things like a shortage of workers, which makes sense. Higher mandated minimum wages, higher recruiting and retention costs, increase in the cost of doing business, regulatory licensing, employee certification costs, and these became even worse during 2020. What else? Here we do. Genworth Mortgage Insurance's Chief Economist Report, third quarter, largest first-time homebuyer purchase market in 20 years. Yeah, so a lot of people, I guess looking to scoop in those low rates, maybe lock them in fixed. This is not any new news. So again, we have another headline based on Triangle RE. This is like the reinsurance. So basically, insurance companies take out insurance, right, in case they have any unexpected losses, just like we do on our car or whatever. So these are the complete rating actions are as follow. Issuers of Triangle M-1A. So they have a BAA2, a BAA3, a BA2, a B2. Summary credit analysts and rating rationale. We expect this issued pool's aggregate exposed principal balance to incur 2.23% losses in a base case scenario mean, and 18.43 losses under a AAA stress scenario. The aggregate exposed principal balance is the product for all the mortgage loans covered by M1 policies of unpaid principal balance of each mortgage loan. And then they talk about some of the other reasons why, they maybe have some pessimistic outlooks on the economy. Genworth announced its termination of merger agreement with Oceanwide. This came out April 6th, 2021. So the article doesn't have much to tell us that's of significance. It's kind of more of a PR type of thing. Hey, good job, everybody. We tried really hard. Sorry it didn't work out. That type of thing. So again, there's an update, but Genworth was the one that terminated it. This is from April 19th, 2021. Genworth announces filing a registration statement for proposed initial public offering by its U.S. mortgage insurance business. All right. So it is the Genworth Mortgage Holdings aspect. GMHI has filed a registration in connection with the proposed initial public offering of its common stock. So it's going to be the mortgage one that they're hoping to bring public. Genworth announced the second quarter 2021 results. Let's see what we have here. Continued progress on the company's strategic objective with strong second quarter earnings. Could be an opinion, not a fact. So if we look at net income, there's net income in the quarter, positive $240 million. It was 47 cents per diluted share. If we compare that with a year ago, it was a loss, net loss of 441 in the second quarter of 2020. So much better to be profitable than a year ago. And then the company reported adjusted operating income of $194 million. So adjusted means they adjust it for typically what you would expect to happen without any special events. Okay, so without any special events, they claim $194 million from like regular core business activities. And of course, that was better than a year ago. So it looks like this says they're planning on doing a planned minority IPO, so initial public offering that which would raise some equity. So it's a little unclear to me what they're planning on using this IPO for, but issued an early redemption notice for the September 2021 debt. Remember, that's the one that Sievert was so worried about. I think that was the $1 billion debt coming due, and it looks like it's possible now to pay some of it off July. The planned IPO of Enact, which is the business segment, remains a key strategic objective for Genworth and is subject to market and other conditions. However, because the company is in registration and subject to applicable publicity restrictions, Genworth is unable to comment further. Okay, that's fair. So this article claims that the company has retired $1.2 billion retired in 2021 of debt. So this is interesting. Of the 200 and some million that they made in profits in the second quarter, 240, right? And then it was 194 if you adjust it. The investment gain net of taxes and other adjustments increased net income by $55 million in the current quarter. The investment gains were primarily driven by mark-to-market gains on limited partnerships in the LTC business, mark-to-market. So these are like on traded securities, I believe, where, you know, if the stock price increases, then you're able to credit that towards net income, which eventually goes to retained earnings. So I believe that's what they're referring to is basically marketable, short-term marketable. I'm not sure if it's held to maturity or, you know, held for trading. I can't remember, but these are basically investments that increased in value. The net loss of 441 in the second quarter of a year ago in 2020 included 77 million of investment gains. So they, you know, invest a lot of that, those premiums that come in. So another thing we don't talk about much, but Genworth effective tax rate was approximately 23%, which continued to be tax affected at 35% as they are amortized into net investment income. But the corporate tax rate increased. It's going to be tough. So we'll just try to take advantage of some of the graphs that we already discussed in the literature. Enact had most of the second quarter 2021 operating income. The green is the life, runoff, purple. Okay. So remember, they're going to try to take Enact as a public separate company. Which is essentially like, basically spinning it off, selling it. You're basically selling it to the public. So this is kind of the thing that I don't think is good. So from a year ago, there's dropping delinquencies. There's a lot less new delinquencies on primary. So I would say that's the big difference. The loss ratio, I'm not sure what that means, but 94%, 22%, 12%. Operating leverage, I would say in this business you would want less operating leverage. It's increasing. Sufficiency to publish PMIERS. So a little bit better operating income. Loss 5 million, 62, and then up to 71. Basically cleaning up the life insurance side of things. These numbers are about the same here, 98, 95. Fixed annuity, a little drop, but the long-term coverage is the big part. The thing is, it's like, are they going to be able to dig themselves out of the hole of all these new people not signing up? Is it going to be enough? Are these IPOs going to work? I mean, are they going to be able to basically, like they said, sell off the profitable parts of the business and use that money to try to pay off some of this debt that they have? So premiums are flat, long-term care insurance premiums. That's why they're going to jack these up a bunch. I said like 100% in the next 3 to 6 years. Anywhere from upward to 100 and I think 56%, what I saw. So this is pretty interesting. Long-term care rate increases, policyholder responses. Cumulative policyholder responses since 2012. So NFO is non-forfeiture option. And this other one, RBO, is selected reduced benefit option. So what do people typically do? These are cumulative. I don't like the cumulative graphs. Paying full amount. So, less and less people want to pay the full price. So people want basically, I feel like it's a real game though, because the options that I saw, the benefits were cut so significantly. I heard a story of one person, they had guaranteed no rate increases at one point, unlimited lifetime benefits for them as well as for their spouse. And then all that is no longer true at this point. So a lot less people want to pay the full amounts. On the life insurance, this is, remember, the segment losing 40 million, but pretty much flat. Fixed annuity, this was an insignificant amount, basically. This is what they do with the extra premium money that they have sitting around. This is actually pretty interesting. This is not right. So they buy government bonds, commercial MBSs. They're in the mortgage industry, so maybe they should be pretty well versed at how that works. And then finance and insurance, 10% utility, 7% energy, non-cyclical, so those are pretty defensive. 8% in tech. Anyways, diversified portfolio, I suppose. Okay, so in the end, it's really hard to say what I would do if I was someone who had been paying in. It depends how long you've paid in, and so that's why I think that spreadsheet will be helpful to you. Disclaimer, use that at your own, discretion or whatever. It's possible there could be an error somewhere in there, and if there is, then that could, kind of mess things up. But I think it's a good tool. It'll get you started. Okay, thanks so much for joining us here at Premier Study and Investing. We're now on the web, premierstudyandinvesting.com. You spell that out, PREMIER, study and, spelled out AND, investing.com. And we appreciate you guys so much. Thanks. We'll have a download link for those Excel files as well. Thanks.